I do think that, Joe. What's interesting is there's such a change in tone from Powell. What's really changed since October 3rd when he said that we are far away from the neutral rate, and then he comes back on Wednesday and says, you know, we don't think that we have a much more dovish tone going forward. So I think if you look at the data, there have been some data points that say, yes, the economy's softening, whether if the interest rates and so forth. But what's really interesting is that what the market has done is sold off 10%. And you can't deny that the Fed is looking at this. And really, I think what he invoked on Wednesday was what you said, which was a Powell put.
So, Doug, you had some similar comments, and that is he's used the dark room analogy a couple of times, that you start bumping into furniture. We didn't really pay attention the first time. That sounds like data dependency. You know, you don't know where you're headed until you're actually feeling your way around. Does that indicate to you that we have no idea about next year? Will there be 1, 2, 3, 0? What do we know?
Well, this is my outlook. I call it the storm before the calm. And think about what the Fed has achieved. He's had 7 rate increases. We're at 2.25% Fed funds rate. Think about that when the president got elected 2 years ago. We were at a 0 rate. We just had the first rate increase. And historically speaking, everybody was afraid of how we were going to unwind this unconventional policy. He's achieved it. That's somewhat miraculous. And I think the market is missing that he's taken a lot of excesses out. Bitcoin dropping, oil prices dropping, the tech wreck. But he is setting the stage for the calm that I'm seeing out in the future. And his indications that we're close to neutral is part of that calm that you should really be focused on.
I mean, in the past, we've seen, we've watched it. We've watched what we've referred to a lot of these traders as crack addicts, or they need to get on methadone, or I mean, over 10 years, whenever QE looked like it was winding down, the market would have some trepidations. I mean, people want zero interest, or not, but any interest rate increase initially by traders is not going to be taken positively, even if it's for a good reason. So it is hard to raise 7 times in a year and a half or whatever it is. And that's like ripping a Band-Aid off, but he did it.
Right. That's why I started ripping the Band-Aid off. So he did it, and what? The market's down this year? Oh, no, wait a minute. It's up slightly. Off an all-time record high. Correct. Traders and speculators, I don't think it's over. I think they're going to get whacked. But investors, long-term investors, retired, they look through this because we have the best economic backdrop that I've seen in 30 years.
And again, Stephanie, the claims number yesterday, it's been a couple, I don't know how many not bad numbers, are historically low, but the trend has reversed in unemployment and housing. People are wondering, autos. So I don't know. People don't like it on the face of it, rising interest rates, but it almost looks like there's some evidence that it's having an effect in the economy, or not.
Well, I think the U.S. economy is still in decent shape. There has been some sectors that you mentioned, such as housing and autos, and you saw spreads blow out a little bit more recently. But I think, going into 2019, there's going to be tough earnings expectation. I think the global backdrop is concerning, that there's been quite a bit of slowing abroad. You saw Germany have negative GDP growth in the 3rd quarter, as well as Japan. So, it's our concern that some of the global slowdown can move over to the U.S. But at this point, with earning expectations close to 10% next year, we think that's enough to be supportive of the market. But there are a number of risks out there. Trade, Brexit, we saw plummeting oil prices. So there is some expectations for a lot of volatility, but we think the economic backdrop at this point is intact. But if we see some slowing momentum or actually a recession risk coming, we're ready to change our equity allocation.